The Hedgeless Horseman here. It's November the 3rd, 2023. First of all, thanks to my sponsors. Second of all, I just looked, I don't know, a few hours ago. Metals didn't do much. It appears that they're up now. Gold is above 2000 again. Silver about $23. And it's like, I mean, you know this. Go and look at Twitter. Just over the past, I don't know, 24 hours, 2 days. I mean, you see the exact same thing. Here, people are celebrating getting bullish. Down here, they're crying, talking about how this sector is and the metals are crap. Kind of celebrating again, crap. Now it's up again. And when you zoom out, I mean, silver has not really gone anywhere since 2020. So it's like 3 years of sideways action. It's not really down that much. It's, I mean, kind of maybe a bit below the 3-year average. But we're talking like 50 cents a dollar or something. But even sideways action is very frustrating to a lot of people. But it's like my point with this is, look at how many swings there are on a weekly, monthly basis and a daily basis, of course. Yet there's not much that has actually happened. But every single time silver runs or rips, people get bullish, probably end up buying, chasing, thinking this is the time to buy silver now, or silver juniors. And every single rally has, I mean, this is sideways or even a slight down trend here. So imagine if you just did like everyone else. You get bullish when the recent past was bullish. You see this, you want to get on board, met with this. You see this, you want to get out because it for sure looks like it's going lower. Lower lows, lower highs. Well, here's the bottom. Up again. Maybe here you get bullish because now you think the trend is, I mean, it's broken out of you know, higher highs. I was gonna say that tops, breaks below this line here, you get bearish again, you sell out. Okay, it rips higher, you think it's gonna stop here, maybe actually pushes through this high, then you get bullish again. Okay, then we're in for a new decline. I mean, you can't make this stuff up. That's why it's like, if you been long enough in this sector or any sector, I was gonna say, especially a cyclical sector, it's like, I don't care. That's why I think it's like, looking in metals or whatever, I think that's just doing yourself a disservice. Unless you're trading the actual metals, which this picture, I would say, suggests is extremely hard. I don't want to do extremely hard things. Well, I like to do extremely hard things in a way, but it's like, why would I spend my time trying to figure out what silver is gonna do in the short term? Nobody pretty much can do that. Do you know anyone that's actually made a lot of money by being a day trader or swing trader in silver futures? There might be a few, maybe. But I don't like this proposition at all. It's like, best strategy just in this case, for example, is to just, let's say, every time it drops 10%, I start buying and then buy more. If you would have done that, at least you would be, I mean, this was a big washout. But if you just average down, maybe you get down to this kind of average here, you would at least be in a profit sooner or later. point is that like you're gonna see it today. People are gonna get bullish a bit, maybe. So gold is about $2,000. I wouldn't be surprised if it is below $2,000 on Monday. So I don't. If you shear the rips, you have to mourn the dips. That's why I try not to get too hyped up or let's say too emotional about stocks going up or whatever, because if you're very emotional about stocks going up, you really cheer every 10% rise in one of your holdings. Okay, you get emotional about the up days, then you obviously are gonna get emotional about the down days. When you stop really caring, because in my opinion, again, it's like the actual trade here, it's not a daily trade, it's not a weekly or a monthly. The next trade is the next major trend, the next major leg. There are, you know, I was gonna say, yeah, multi-month legs all over the place here. Here we have a from August to November, that's a leg down, then a small leg up, and then a bigger leg down, and then a bigger leg up. I mean, these in themselves are pretty large, but there's some many smaller ones within that. But I don't know how to trade short term. I don't know how to. I mean, if you look at the daily charts, or again, it's like just silver. It's like, imagine trading every single one of these. That's just too hard, in my opinion. The more extreme this sector gets in either direction, from a long-term macro perspective, it just means it's saving up fuel for the next big mean reversion. Given that it's zigzagging, so there's you can have a mean reversion that goes something like this, and here it's under the mean, it goes up, above the mean, yada yada. But then you have obviously like a macro mean reversion, up here to down here, mean reversion up, mean reversion down, yada yada. So it's like, that's the stuff you can kind of hodl. I mean, you can't really. I mean, how do you? I was gonna say, how do you hodl on a short time frame? How do you set yourself up for a big payday on a short-term basis? No, I mean, I think that's extremely hard. What we do know is that this sector mean reverses every. I mean, this was 2008, 2016. That's like a 8-year. Yeah, like an 8-year cycle, if that's what you want to call it. So major bottom here, 8 years later a major bottom here, and this might have been 8 years. And I mean, we're not far off from that. So it's like, I'm not saying I'm trading on time cycles. I'm trading on valuations, but it's like just these last two major bottoms happened 8 years apart, and now we have an extremely low valued sector again, which happens to be around 8 years after the last one. So valuation wise, this sector should bottom today and go up. And we know the thing is that when this sector goes up, it starts a trend, and it's the trend that really gets people buying. So we should form a bottom and start a new trend any day now, simply because of the valuations. That's a risk. That's a chronic risk when we're this cheap, because we know this will not last forever, like every high doesn't last forever. I think that's pretty straightforward. And again, in the meantime, whatever the metals do, I mean, I don't really care about that. I mean, I'm mostly invested in miners, and if you follow the metals and I mean, look at gold, for example. Would you guess that gold is a $2,000? Absolutely not. So even let's say you were right on, you were one of few that could predict the gold price. Gold is at $2,000. If somebody asked me, do you think the gold juniors will be trading at $10 per ounce or whatever when gold is at 2,000? I would say not a chance in hell. That would be crazy. Never seen it before. I mean, 2,000, that's near all-time highs in gold. We're like $80 or $70 from an all-time high. Do you think that the gold juniors will be priced like they were in the bottom of a bear market? Absolutely not. Which kind of goes to show they have a life of their own. So why would I focus too much on gold and silver? Even if I was right on gold in this case, if I believe gold is going to hit 2,000, it's going to be at 2,000 today. Yeah, I mean, I hope you get what I'm saying. It's like, even though gold has done well, the gold juniors have not done well. I mean, gold juniors. So I mean, that's kind of the lesson for me is that why put emphasis on where gold is or where gold is going? Because if you're in miners, you're not even sure they're going to follow that closely. And we've seen they have not followed at all the actual gold price. Why would I put, let's say I am a mining investor, which I am. How much time should I be spending thinking about where gold or silver is going to go in the short term? Or even the medium term? I mean, it looks like we should spend absolutely no time looking at the prices of metals. We should not let anyone's charts really influence us at all. Most bang for the buck has to be to focus on what we're in. And weirdly enough, again, we're in the gold space, but still, the gold miners, which are also, I mean, they are in the gold space, and still, they haven't really tracked gold very much at all. And there's a bunch of reasons for it. I mean, you can come up with, capex and all of that. So I'm not saying there's no reason for it. I'm just saying that obviously, if you think about that, okay, even though they're in the gold space, but not even gold can really predict how the miners will move. And you're in the miners. So again, how much time should you be spending thinking about where gold price is going? The way I see it is the gold price or silver price, whatever, that's the bonus. That's what we want to have in the back pocket. I'm long-term bullish all metals, pretty much. So I think from a long-term perspective, and that's also, I mean, this chart is showing the next mean reversion is going to be higher. That might be, a few years out before we reach the next cyclical high. So we're talking a few years in time frame. And gold has always, I mean, it's higher than it was, 10 years ago, it's higher than it was 20 years ago, etc., etc. So gold price always goes up because that's what happens with currencies, they debase. So we know the long term. It's like when people think, 5,000 gold is out of the question. It's like, have you seen a historic gold chart? You can pick any number at all, and in nominal terms it's going to be going up until they do a currency reset. Gold has always been trending up on a long enough time frame because currency is always the base. So you can pick whatever number really, and there's higher, and there's a high likelihood we'll get there, simply because that's how human civilization works when it comes to currencies. So I'm long-term bullish. I know the next big long-term trend is up in juniors, so that's where I want to be. In the meantime, you can have AI or whatever, Nvidias, they might pull a double or something, even from outrageous valuations. But that's betting on something that's probably overvalued becoming more overvalued. That's not a value investor's cup of tea, really. I want to stack the odds in my favor. I don't just want to bet on an outrageous trend becoming more outrageous. I would not be shorting this sector right now, for example, in the junior sector. Even if I had a strong belief that's like, yeah, I don't see what can really make it go up today or tomorrow or start a new downtrend. It's like, I don't care, because I know the next big trend is going to be up. Because we're at an extreme low. But there's still, I bet, people shorting the juniors. Because they've been kind of, you know, they've been on average looking very right over 3 years. And that kind of enforces people's belief in, you know, the trend looks even stronger. And they have the, let's say, 3 years of experience to back that up, that they've been looking right for 3 years. Even though it's getting increasingly dangerous. Because it's getting more and more stretched. But you know how that is. But I just want to touch on a comment here from David. I did a big massive copium, yada yada yada. Talked about some stocks as well yesterday, I think. I got a comment here from David. Come on, man, let's cut the crap a little bit. I don't think this is such a straightforward buying opportunity like you always say. Yes, it is. Absolutely is. If it means the sector, of course it is. I mean, how can you look at, go and look at any junior worth its salt, basically. If it's not a straightforward buying opportunity, what you're saying then is that it's not clear that this is undervalued. And then you pick 10 of the best or whatever, and you still can come up with them being undervalued. The thing is that obviously every mine runs out of ore. So if the 10 best projects, which are kind of the first in line to become mines, are not even pricing in anywhere close of becoming mines, that's pricing in that the mines operating today will forever be operating, and there's not going to be a demand increase. Again, it's like infinite supply at the same pace, and there's not going to be any demand increase. Does that sound likely? Will every gold mine or silver mine or whatever mine be operating 100 years from now or even 5 years from now? Do they have infinite supplies? They don't. Every single mine that Barrick or Newmont operates today will run out one day. Every single operating mine of any company today will one day run out. And I think it's common sense to think that the best projects, undeveloped projects, are the ones that's probably going to get into production first. There's not many of them, I would say, that are priced like they will be anywhere close to a mine in the next 5 years, perhaps. And that might not even be the case. But then in that case, you have an even bigger supply problem. And then, okay, so it's like, I mean, obviously he does not agree with me. And typically, when someone and I have friends who are like that as well, or friends of friends, like if someone is bullish or sees something and another person can't see that, I mean, you might get upset. It's like, you know, it sounds like I'm missing something, but I don't understand what I would be missing. I just can't see it. So, you know, it's like, you know, cut the crap a little bit. So I'm, you know, I know what my returns are. I know that my strategy has worked since I started out. So if that's crap, well, I have no evidence to back up that's crap. That's what I'm saying. Because I think I do better than 99% of people if I had to guess. And again, if we just take I don't think this is a straightforward buying opportunity. My question is, what is a buying opportunity in that case? because then he goes on. It's like the smaller the company, the worse. Why? What does that mean? It's the smallest companies, first of all, that tend to do the best from here to here. There's not going to be a single microcap, or up here, I don't think there was a single gold junior that was trading under 10 million, for example. It's the smallest companies that require the least amount of capital to move them the most. So that's just a blanket statement. The smaller the company, the worse. Okay? Why? Why is that? Why is that necessarily so? Is it an indication that they don't have much? Absolutely. But why is it the worst? Or why are they the worst? Do they have the worst projects? Maybe. Probably. Are they the earliest stage? Probably. But again, this market is not really, it's like fundamentals right now, for example, is an afterthought. Everything went up when we went from here to there. That's not rational, but it still happened. And almost everything is dirt cheap right now. Even though they shouldn't be, because again, they're pricing in like we won't have a sector, mining sector in the future, which is absolutely crazy. But it still happens. And it's some of the smallest companies that move absolutely the most. So let's say you buy the smallest companies. You're extremely lucky of bottom ticking them. They go up 800%. Would you be complaining and call them the worst? For you at that point, they were the best. They provided you with the best returns. So again, it's all about perspective. The smaller company, the worse, and I don't know what the conclusion is here. It's like, well, if you think so, don't buy the smallest companies, okay? The management team, there's no integrity in this sector and best-in-class processes. I made 600% from here to here. In pretty crappy companies, I might add. I didn't know much about mining at all. Integrity, I didn't know the management teams really. Best-in-class processes, probably didn't know much about any processes. But if that's the problem, so the management team, well, it's not like there's only bad management teams. You have management teams that are serially successful out there and they're still running juniors. So that's also just a blanket statement. Costs are blowing out of proportion, and I don't remember the last project which delivered in line with the expectations. Okay? Costs are blowing out of proportion. Yeah, that's a blanket statement. But it's like CapEx has been going up, inflation is up. Well, but don't buy, I don't know, advanced junior which plans to go start production or raise money or whatever. I mean, I don't know if I'm in, I don't think I'm really in any, I mean, there's no way a junior is going to self-fund a large CapEx project, for example. And it was the same thing here. I own Bear Creek Mining down here. They're not going to they were not going to finance their mines. There was no money in the sector. It still went up 500-600%. Because that's what people do in this sector. When they get bullish, they buy, and they buy beta. Okay, Bear Creek Mining. I bought it because it had 500 million ounces of silver. And that's why other people bought it later on as well. But so I made 600% or something on Bear Creek from the bottom to top. Despite the fact that obviously they were not going to be able to finance the project. So it also, I mean, like I keep saying, this is not a, investing really is not a science, it's an art. And again, I don't remember the last project which delivered in line with expectations. I guess that's development projects is talking about. And yeah, I'm not into many developers right now, simply because, yes, there is a capex blowout. But every single reason he lists here. So I mean, this is kind of, I was gonna say, a bit of a victim mentality. So he can't see it, you know, calls it, you know, let's cut the crap, and then just comes up with a lot of excuses. This is kind of victim mentality. He just throws out a lot of stuff, like he doesn't think it's straightforward. He doesn't see it as a buy. So he just throws out a bunch of, you know, blanket statements why he's right, why he should be right, feeling that no, it's not easy. And then yeah, again, it's like, well, everything of this is kind of fixable. Well, this is kind of, I don't know what you really do with this information. A management team, there's certainly ways to, you can look up the management teams, you can Google the management teams. Just saying that, you know, oh, you can't buy right now, or I can't buy right now because every single management team has no integrity and no best-in-class processes. That's just excuses. Costs are blowing out of proportion, and I don't remember the last project which delivered in line with expectations. Well, don't buy developers then. Okay, fix that. It might work with an ETF approach in terms of buying a well-balanced portfolio of small miners, but holding these individual crapcos is just a horror show. What does he mean by that? An ETF is a basket of juniors, and you can have a basket of juniors yourself. Again, holding these individual crapcos is just a horror show. Yeah, that's why almost nobody makes money. Do you think a lot of people bought these, quote, crapcos here? No, I did. I made a lot of money on it. Anybody who bought a lot of crapcos here made a lot of money on it. So just because it's emotionally hard for you, which it is almost for everyone, that I mean, what we know the facts. The facts are, when this sector rallies, everything goes up, especially the crapcos. We know this. This is a fact, okay? There was, I don't know how many companies from here to here did not go up. You could probably bought 100 crapcos and like 98% of them would still be around. If they survived the bottom, if they were still around for the turn, you would be up. Yeah, but holding this is just a horror show. I hope you can. It's like this is very human, of course, and this is why. I mean, he kinda summarizes why most people will not be making money in this sector. But you don't typically see me. I don't remember last time. You know, you don't see me whining in forums or on Twitter. If I lose money on a stock, maybe it was a bad buy. Maybe I missed something. Maybe I didn't check the management teams. Maybe the exploration story just didn't turn out in the way I hoped. And again, that's the norm. That's why if you're in these micro cap, high risk, high reward plays, and you get pissed off about every single one of them that doesn't work out, even those, like, if they do actually work out and find something of significance, they might be pricing in, you know, they might be so lowly priced that they should go up, you know, 20 to 50 times from the bottom. It's like, if you think that, yes, you should, every single high risk, high reward play should work out, what you're saying is that it should be the norm that you get 20 to a 50 bagger on every high risk, high reward company pick. No, that's not the case at all, obviously. The chance of success is typically very, very low. That's why, you know, there should be hopefully a few that make it, maybe 1 out of 10, 2 out of 10 that pay for the rest. That's how it works. And yeah, I mean, again, it is a horror show. Why? I mean, this is feeling, but holding these individual crap codes, it's just a horror show. Yeah, it is always a horror show. Everything goes down, and that's why I don't like pure beta typically, because I just don't like the idea of holding something I don't think has any value. Even though I still know that what has no value will look like it has a lot more value some point in the future. I'm struggling to understand how you follow so many companies in detail. Well, I think about juniors pretty much every day. If you have a full-time job, you have a family and all of that, how are you expected to keep track of every company? That's pretty hard. And that's why most people should probably stick to ETFs. Because otherwise, it's like what I think Rick Rule says. He has a rule of thumb, like, if you can spend 8 hours a week on due diligence, checking out the juniors, etc., or checking up on your companies, whatever, then you should own like 8 juniors, something like that. I don't remember exactly his quote, but something like that. So I don't expect anyone with a full-time job and a family and all that to be well immersed in the junior space. But then also it's like it's up to you. It's your responsibility to know yourself, know your circle of competence, and it's like choose the companies where it's like, and that's where management team really comes in. The ones, hopefully you find a junior that has a lot of skin in the game, management team has a lot of skin in the game, and you're like, the bet you're making is that, well, since they have so much skin in the game, since they have so much risk involved, they're gonna be up late nights almost every day thinking about how to solve problems and create value. So you're betting on their self-interest over the long term. If you spend few hours looking at juniors and you just pick whatever crap comes your way, and you think, well, I deserve really good returns because I just threw some darts. I mean, you could literally probably throw darts right now, and the ones that survive going from these levels into a up leg, you might actually end up making money. But it's like, how many people will actually do that? And also on your website, your portfolio biggest holdings change quite a lot month to month. I wouldn't say they change too much. I mean, the HODL portfolio hasn't changed that much, but I am proactive. But it's like in the HODL portfolio, there's not too many changes. And keep in mind, like you always say, I mean, the prices change on a daily basis. One day of volatility might justify selling out the 10th largest position to buy a completely new company. Simply because, let's say, price went down in one, or there was some news out that completely changed the case. The value went up 30%. Let's say you think it's worth 100 million. Put out some news, you think it's worth 130. It was trading at 30 million. No change in price. All of a sudden you get another double, the market cap added in value as per the news. All of a sudden, obviously, that's a much better buy. But that means you also have to, put the time in to read the news, kind of understand what the news might be. It's like make no mistakes, like I'm after the best possible returns. And I do this full time. So if you, I mean, it's quite unrealistic. If you think, I'm just going to put a few hours in and then I expect to have the same results as me, for example, that's totally unrealistic. That is absolutely totally unrealistic. It's typically the ones who work the most that make the most money. And by working, I don't mean necessarily, you know, the one who trades the most. One of the best investors I know, he can sit in a company, he does a lot of due diligence, and he can sit in a company. It's like he can wait a year or so for something to happen, and then he'll make 300%. That's not a lot of people who can do that. They don't have the patience, they don't have the due diligence, they typically don't know what they're doing, because he also does a lot of due diligence. He calls the management team, he talks with other people in the industry, he does more due diligence than me, I would say. So I'm even lazy compared to him, I would say. Again, it's like you could probably do well by not doing too many changes. If I did this, for example, here, it's like, okay, where are we now? We're in a risk-off environment. Survival is the name of the game. Why? Because the important thing is to be on board for the next big change. If you have all your companies, they might be very cheap in absolute terms, or low priced in absolute terms. You have 10 juniors, all of them are running on fumes, they have no cash, they have debt. Is that a good strategy? Yes, if it turns tomorrow, well, if this was here, yeah, you'd probably make it out alive, and those very companies might go up 1,000%. But if they run out of money here and go bankrupt around here, you're not on board for the turn. Let's say you own 10 companies. You just, again, it's like, oh, they look cheap, so I'm buying that, and then you expect that I'm so smart, I should make a lot of money because they look cheap to me. You did a few hours of due diligence per company. Every single company goes bankrupt before the turn. It's like, oh, life is unfair, this sector is so crap, yada yada yada. No, that's on you. It's like you want to skew the odds in your favor. Just throwing up your hands like, well, I bought something and now I expect to make a lot of money with 10 hours of due diligence, then I pick my companies, and then I expect to make it out like a bandit. I mean, how again, realistic is that? And that's, of course, why crypto was such a fad, I was going to say. Because that was kind of easy money. People didn't do much more due diligence than listening to people saying this is going to the moon. And the recent past was showing it that it was on the way to the moon. Crypto are the kind of perfect trading sardines, because there is no real value to discern. Yes, there's a bunch of like technical hocus pocus, whatever, but that didn't stop 9,000 cryptos from all going in a bull market, because nobody could say what they were worth. So they are the perfect trading sardines, and that's the best thing for people. It's like, oh, I don't even need to do much due diligence, because they are just going to go to the moon just for whatever reason. Great, I'm going to buy that. Nice. I don't have to think about things. I don't have to calculate anything. I don't have to think about scenarios or risk or whatever, because the consensus is that they're just going to go up. Okay, so shut up and buy. That was easy money for a while, until everybody kind of blew themselves up. So it's up to you, obviously, to put yourself in the best possible position. It's like, these are my thoughts here. Okay, we're down here. Again, the main event is the next big multi-year move, okay? Where's the next big trend going to be? Up, okay. How do I make sure I'm part of it? So I can be part of these lows here, so I can afford the next bear market, let's say. Well, survival is kind of the name of the game. That's a pretty important thing. Again, if you're only in half-dead companies, no access to capital, no cash in the bank, and let's say they are, absurdly cheap simply because they are so risky. Because if this shitty market conditions continue for 6 months, they might, there's a 50% chance they will bankrupt. Is that good risk reward to put a timer on that? Yes, I'll make a lot of money if it turns tomorrow, but if it does not turn in the next 6 months, I might be bankrupt and I miss out on the whole sector because I have no capital left, because every single junior I owned is bankrupt. So that's greedy to me, at least, to take the absolute riskiest stocks, because yes, in a perfect scenario, the sector bottoms today, they go up and they have no problem with access to capital, because up here it's risk on, premium on blue sky, and potential, and typically that's what an early stage junior is, only potential. And up here it's good access to capital, bankruptcy risk low dilution risk, etc., etc. But that's up here. Down here, survival name of the game, blue sky, potential gets discounted hard. I mean, people don't care, and you've seen this. In this market, nobody gives a crap about potential. Potential does not get priced in unless it's a very rare case, like, Hercules Silver, for example. It's like a tiny fraction of companies get anything by the market for potential. Up here, back here, for example, I go back to Garibaldi Resources a lot. Before a single assay was out, all they had was potential in a project that has already kind of been drilled. That company went up to a market cap of, I think, $560 million only on potential. Only the idea of people maybe making money, of them maybe having anything. Nobody gives a crap right now if you might have something. Even if you have something, you're probably gonna get 30 cents on the dollar. So you have to adjust for that. Again, I feel like a lot of people expect too much from very little work. They just assume, or it's like, if you're just, let's say, following me or whoever it is, let's say, it's like, if you expect to have the same results because you watch a video now and then versus me, who is thinking about juniors all day, every day, that would be super weird, and that would be, that's totally unrealistic, I would say. I mean, the first step is to learn to walk. And I think the first step of walking is to realizing that this is a straightforward buying opportunity. And that's despite all these excuses. Because it sounds like you're kind of giving yourself, you throw out a lot of stuff, which you can for sure be proactive about. It's like the smaller the like I said, smaller the company, the worse. Well, if you think that, if you feel that way, don't buy the smallest company. The management team, there's no integrity in the sector and best-in-class processes. This is pure copium. There for sure are good management teams out there. But again, that's up to you to do the due diligence in that case and find the ones. Just to be, I mean, it's like a lot of people demand it or expect it to be super easy. I don't need to do a lot of work, but I expect huge returns. 95% of people don't even beat an index. Costs are blowing out of proportion. I don't remember the last project which delivered in line with expectations. Again, you can get around that if that's how you feel. Don't pick high capex projects. Don't go into the developers. So again, it's almost like I'm throwing darts out there and I'm hitting some of these companies, and then I get pissed off because it's not, I lost money and whatever. I'm being proactive. I'm not typically in high capex projects. I mean, there's like what? I mean, an advanced junior with high capex, that would be kind of like Eloro, for example. But the same thing with Bear Creek Mining, which was a high capex project. These beta plays will go up anyway. But in this market, everybody hates those kind of companies, which makes sense. But we're not playing for the future, or the past and the current. Well, the past is kind of irrelevant. The current is only relevant how it relates to the future. So you could have bought only a high capex project series and you would still make money. Every single high capex, highly levered, super beta play went up a lot over this move, probably 500% or something. Here maybe 1,000, 2,000%. So again, it's not even, I don't know. I don't know how to describe it, but I hope you get what I mean. That it can, something can still be true, but it's from a investors or speculators or traders perspective. You can still make money on it when the right conditions comes along, and especially relative to the current conditions. So yeah, I mean, let's take a page here from I was able to find the clip here from Pierre Lassonde.
Buy low, sell high. The gold mining business is, to my mind, the easiest business to make money in. Now, of course, I know it intimately, so you know, for me, I would say for you guys, you know, you may look at it as like, you know, he's completely stupid. But here's why. At the bottom of the cycle, the gold business is always, always, always undercapitalized. Always. People hate it. I don't want to have anything to do with it. I'm selling. I'm never going to have another share. It's always undercapitalized. And at the top, always overcapitalized. Always, always. So if you can really just be a bit of a contrarian and be in there at the bottom, and then when they're clamoring for gold, just give it to them, you can't go wrong. It is, I've seen it now 7 times, okay? Since 1974, this is the 7th cycle.
And this was done in 2016, this conference, which I assume is somewhere around, I don't know, maybe here. So it's like what a lot of people are going to say, well, even if it was done here or here, whatever, in this case, people would say, well, that wasn't even the bottom. So he was wrong. No, I mean, the point is that obviously you don't even need to be, first of all, you don't need to know when the bottom is in, because if you think it's cheap here, if Pierre Lassonde, for example, thinks that, well, already here it's just dirt cheap, what happens when it becomes cheaper? He would obviously buy more, lowering his average, so then it doesn't really matter, because if he starts buying here, buys all the way down, maybe his average is at least down here. Well, that's a massive profit sooner or later anyway. So I mean, if this was the bottom, let's say he starts talking about it here, and it goes straight up like that. Okay, that's 300%. That wasn't the bottom. It got cheaper. So he was taking on paper losses, but he bought all the way down to the bottom tick, because he knows that this is just a buying opportunity that just gets exponentially better. Maybe he brings his average down here, so he'll make 100% more. So the question is again then, was it good or bad that this sector got cheaper, even cheaper, that you had even higher paper losses on your original purchases? He would end up making more money thanks to it getting even cheaper. So it's like when you don't see why this is straightforward right now, I think you have a lot of things to or ponder about investing in a cyclical sector. Because what are we seeing out there? He said this sector is always undercapitalized. What are companies right now? Very undercapitalized. Everybody's talking about how hard it is to raise money. A lot of companies are running on fumes. It's the telltale signs of a sector bottom. And like he says, at the bottom it's always undercapitalized. It's always risk off. There's bankruptcy risk, dilution risk, blue sky potential gets discounted hard, but the opportunities obviously when we go from what he calls, when it's overcapitalized, yada yada. When we go from here to here, that's on the long side that's the best. That's the big trade in this sector. That's the big trade. Go from undercapitalized to overcapitalized. The big problem, or when we face a lot of losses, is when we start buying at only risk on, where there's a lot of good access to capital, like Garibaldi, when you have a market cap of 560 million without a single assay. That's as risk on as it gets, and that proved to be around the top of a 2-year bear market. So again, if this is not a straightforward buying opportunity, then I don't think you understand this sector at all. And you would probably get pissed off just listening to this clip of Pierre Lassonde. Because that's also my intention. And I said that in the last video. That's also my intention, to kinda, as I call it, create a kind of call to arms. That it's supposed to, if you don't see it, you're supposed to kind of get upset. But that's a trigger for action. Okay, I need to understand this more. Why is this hedgeless horseman saying that, how can you, why is this sector so easy, how can you lose? This is basically what Pierre Lassonde said. And almost nobody would obviously agree with him. And if you don't understand this sector, which most people don't, and if you can't cope with the volatility, which most people don't, and if you only bought in, you started buying here and you're sitting in heavy paper losses, which a lot of people are, then you're gonna get probably pissed off just hearing Pierre Lassonde calmly say that he thinks this is the easiest sector to make money in. And of course, if you interpret that the wrong way, you're gonna think, well, I invested here and went down here, so how can this asshole call this an easy sector? Well, that's just that's just one side of the coin, obviously, because the other side of the coin is when we go from low sentiment to high sentiment. If you only seen high sentiment to low sentiment, where it's very, very hard to make money, of course you're gonna think that this guy is full of shit and I'm full of shit, and like, oh, like you always say. Yeah, I always say that, especially when we're this cheap. And I'm a stock picker primarily, and I've heard people say that. It's like, well, you're always bullish. Yeah, I've been 100% long ever since late 2015. But I'm a stock picker. Up here, I'm bullish. I'm 100%. I was 100% invested in up here. It's just that you pick companies which you think are at least the cheapest ones. I was in Garibaldi Resources for a while. I think I sold at 100 million or maybe above that. I don't know how high the stock went. I think it went to like $5. I might have sold it at the last ones at 1.3. So I missed a huge run. But I wasn't getting into Garibaldi Resources at 560 million. The risk reward was simply not there. I was hopeful in something much, much, much cheaper. So when the downturn came, maybe I was in growth stocks and they were able to, grow a bit, etc. To limit, cushion the fall. Because and I've said this and I tweeted about this, the goal is, in my opinion, if you're down 50% in your portfolio going to a low, I mean, that's not really a problem because this sector does hundreds of percent from the bottom tick. And again, I'm not in from the bottom. Well, I am always fully invested from the bottom tick. But I never am out of it and then 100% all in on the bottom tick. I have no idea when the bottom tick is. People knew this was the bottom up here. Because otherwise, I mean, look at this movement here. Why did this stop here? And why did this not stop here? I don't know. But this wasn't the bottom, but it sure looked like it at the time. And that's what I mean. It's like, okay, now we know that this was not the bottom when it broke this. So we kind of knew that this was October last year, and this was... So it's like a year later, we got confirmation that this was not the bottom. A year later. So if you're trying to be a market timer and bottom tick, and why this is not straightforward because it can get worse, we'll know when the bottom is in a year later. When did you know that this was for sure the top? Would you know that here, when it made higher highs and higher lows? No, maybe down here you knew that this was the top. So the best opportunity we'll know, or the worst time to sell or buy, we'll know that a year after it has already happened. I can't wait for that. I cannot buy here, conclude that this was the bottom here, buy in, and then complain about this sector and how it's so hard because I bought in close to the next top. Same thing here. I have no idea when the bottom is going to be. I'll know what the bottom is in a year after the bottom is in. I didn't need to know this was the exact bottom. This was cheap enough. If it went lower, I'd just buy more. So again, in my opinion, I understand your frustration, whatever, because I mean most people who this sector is brutal in a sense, or very brutal in a sense. But I think I think you calling it, let's cut the crap, I think that's because you don't fully understand how this sector works. And you got some stuff to do, because this is smelling like victim mentality. You just throw out a lot of reasons why it isn't straightforward and why you can't make a lot of money. And you want that to be true, because that's kind of, confirmation bias. Then I don't feel bad for not actually making money, whatever, and I can just, conclude that, well, I don't, you can't beat this sector because all of these reasons, and then you can be okay. The ego is intact because you just listed a lot of reasons why this sector is so hard and why you should not be buying right now, even though in my opinion, we've been in ever since here, I would say we've been in a permanent buying opportunity. That's just gotten better and better. And if you listen to Pierre Lassonde, that's again going to trigger a lot of people when he says this is the easiest. He thinks this is the easiest sector to make money in because it always crashes and always rallies, which is the case. So it makes perfect sense. It's just that most people can't see that, won't see that, and a lot of people won't do enough due diligence, because I see a lot of people, I think, there's some portfolios floating around on Twitter. People show their portfolio, and I don't know every single company, but it's like a lot of the companies I'm like, I wouldn't be buying those companies, I wouldn't own those companies. And then I just think like, okay, they might get burned on most of those stocks. And then they're going to conclude that this sector is shit. But I don't think they might have put in the work, let's say. But also it's like if you are playing the trading sardine way, if you are into high beta stocks and you're like, I'm after when not if thing. Okay, I think these beta plays, they have resources in the ground, they have cash, they have some pretty good access to capital, then you have to know the game you're playing, meaning that they will do absolutely nothing but go down until sentiment improves. And that is the most brutal aspect of it. It might make perfect sense to switch to beta plays only here already. But to see them go down 50% or whatever, that's not fun at all. Because nothing really changed with the company, same resources, they haven't created much value, but they're down 50%. Okay. Still, that's the game you're playing. So I mean, if you understand the win conditions, let's say, that you understand that, okay, I'm getting into beta plays, and I know the win condition is when the sector inevitably bottoms and starts going up, I'm going to make a lot of money. Until then, it's going to be like watching paint dry or getting dragged across concrete, because they can still go down 50% more before that starts. And that's typically too much for people to handle. And I hate that feeling myself. That's why I dislike beta plays typically. But like recently, I've talked about this a lot. I've been starting to, when I get more cash, when I get dry powder, I'm typically going into the more advanced juniors. And I would just like to point out other stuff that's also kind of due diligence, because we want every edge we can get. Okay, what are some geopolitical trends? Take first world jurisdictions or tier 1 jurisdictions. That typically like USA, Canada, Australia, Scandinavia. Okay, what's the problem with these jurisdictions? Well, first of all, the best parts of these jurisdictions is that there's a rule of law. You're probably not going to get your project nationalized. You're not going to get it taken away from you. So you kind of know that tomorrow when you wake up, you will still own the project. That's great. The problem with a lot of Western jurisdictions is, on the other hand, that it's very hard to permit anything. So you get to keep the fruits of your labor, but you might have a hard time monetizing it. So it's like a trade-off. Take some places in Africa, for example. It might be really straightforward and easy to permit a mine and monetize it. It's just that there's that underlying risk that something happens politically, or there's rebels, or there's armed militia, whatever, or there's a blockade and stuff like that. So it's a trade-off. Yes, you get to monetize, you could put it into production, but it might get taken away. In the West, it's more like nobody's going to take it away from you, but it might be hard to monetize, because you can't, again, put it into production. So it's like any project, if you can build a mine, it's like you saw with First Quantum Panama. You build a mine, great, we were able to build a mine. Somebody takes it away from you. Well, that's worth zero then. Or nobody takes away the project from you, but you can never permit it. Well, that's also worth zero. It's just two types of risks. So when we think about, okay, again, West, the problem in the West, well, people tend to want to be in the West, and I think especially the more chaotic things get and the more East versus West is heating up out there around the world, I think when it goes really risk off, I think Thomas Kaplan might be right that there's going to be a bubble within the bubble, and that's going to be in the tier 1 jurisdictions. When people are scared, and maybe again there's a run on gold, silver, whatever, and people need to actually go in and buy mining companies to get exposure to it, because you can't really buy the physical. Are people gonna flock to a project in Sudan, a gold project in Sudan, or are they gonna tend to flock, if they're Canadian, will they be buying a Canadian mining company with gold ounces in the ground in Canada? I would think that they would, if they're scared and all that, thinking of preservation of capital and yada yada, the world is going up in flames, I think they will much rather buy in Canada. So I'm kind of front running that as well, not only the mean reversion overall, but some geopolitical trends. And again, okay, so what do I think are let's say some criteria. Okay, if you have a project in the West, yeah, it would be even better if you have pretty good permitting there, or they have permits or whatever. I mean, that would be superb, because that's like the main risk in the West. And nobody gives a crap right now, because nobody's pricing that stuff in anyway. So it's like, if you add up a bunch of criteria and you're not even paying for it, and you think it's going to be a big deal, increasingly big deal in the future, that's absolutely great. I mean, if there's a company with like 5 competitive advantages that's not priced in, and it's trading at almost the same valuation as some other almost identical company, but it does not have the permits, it does not have, I don't know, low capex project, or no infrastructure, whatever. It's like, obviously you get a lot of more bang for the buck in the one that's got permits, good infrastructure, yada yada yada. That's going to show up sometime in your profits and loss column, because that project might be 3 times the value of the one that does not have those criteria checked, but still they are trading at almost the same price right now. So you want to add as much value and edges as you can in any company you can find, obviously, but all of that takes time. That's due diligence. The more you work, the more you look into this, the more you think, the more you include. Again, it's like, you can just look at ounces in the ground, but then you can add geopolitical trends, you can add permitting, you can add management, you can add access to capital, etc., etc., etc. The list is long in terms of how many competitive advantages a junior might have, and you'll only find that out the more you actually do research. And then, you know, the underlying condition is that, well, you might find something that's super cheap, and you have to be comfortable with the idea that nobody cares right now. And they might not care for the next month or next year, but someday they will care. So if you expect to look right immediately, that's just not how the markets work. Markets can stay irrationally greedy for a long time and irrationally fearful for a long time. Well, this turned into a big rant. And again, I don't mean to pick on David. I mean, I appreciate the feedback, but I think this is a good opportunity to just highlight a few things. That's like, a lot of the stuff, well, what a lot of people do is they can't figure something out, let's say. They don't see it, and they get upset that they don't see what some other person is seeing, and then they want to make sense of it, and then, you know, I'm not going to say lash out, but it's like, well, that's crap, and here's why it's crap, and then they throw out a lot of, let's say, excuses. But when you really think about it, it's like, all the potential excuses or whatever, you can work around that. And some excuses or you know, points might be true, but it won't matter in the end, depending on how you play it. Again, it's like, there's no way that high capex projects were going to get built here, but that didn't stop them from going up 500%. And there's no way a junior is going to finance a high capex project in a, you know, high rate environment with cost inflation. But that might also mean that there's not going to be any projects built, which we're seeing, and some are actually getting, you know, risk of being nationalized. What's that going to lead to in the end? Because the mines are finite. Well, it's probably going to lead to a, you know, much higher metal prices. And in that case, when that happens, maybe these high capex projects, etc., will be worth a shit ton, because the metal prices overshadow the cost of inflation and rates, etc. I mean, if gold went to, or whatever metal, copper went to $10 or whatever, even with the high rates and high capex, that some of these big projects might be cash cows anyway in that case. And if you buy them when like right now, and what Pierre Lassonde talks about, they're very undercapitalized or whatever. Let's say you buy a high capex project at 30 million, a huge project, whatever, and copper goes to 10 in the next 4 years. and the company is still around. And on paper, all of a sudden, that project makes a lot of sense. Maybe it's worth 3 billion on paper. It's not going to be trading at 30 million in that case. And even if you dilute it by 50%, that's up to 60 million. That's still, you're probably going to get a 10-bagger at least in that. So again, there's a lot of stuff that kind of makes sense, but you can work around it, or it doesn't matter in the end because we're after, it's already priced in and stuff like that. So it's like, what again, with the call to arms thing, it's like, I kind of want people to get almost upset listening to Pierre Lassonde, because that's a signal that's like, if I get upset listening to Pierre Lassonde when he says, well, I think this is the easiest sector, and I'm sitting there like, what the hell is he talking about? I'm down, 70% in my portfolio, whatever. But if you listen to what he says, it's like, okay, because this sector always goes from undercapitalized to overcapitalized, then I can think like, oh wait, I've only been a part of this sector when we went from overcapitalized to undercapitalized. What he's talking about, why it's easy, is because it's going to go up as well. So I should probably be buying, lowering my average. And when that happens, when I see not only half the picture, but the full picture, okay, now it makes sense. Oh, of course, yes, of course. And you can go back in time. It's like, yes, absolutely. Every time you had these big crashes, they were always followed by a big rally. Now it makes sense. So he's saying it's predictable because people work the same way, that this sector behaves the same way. It crashes and then rallies and crashes and rallies. Okay, now I'm starting to get it. Now I start to understand what Pierre Lassonde sees. And then it's like, okay, so I need to only be patient and wait maybe months, maybe years from us to go from here to up here. And that's how I make money. And yes, it checks out. Okay, it makes perfect sense. Some things to think about. Okay, make sure the company is still around. Survival is the name of the game. Can I add some geopolitical trends to my arsenal? Okay, have some criteria that's like, okay, I think the West is going to be, tier 1 jurisdictions might get harder in the future, but we have the permitting problem. Well, can I find some juniors that are trading very cheaply right now? Maybe with some ounces in the ground, so I'll be sure to get the mean reversion move because they have ounces to revalue, and maybe they have some permitting competitive advantages in terms of permitting. Maybe it's not a super high capex play. Maybe there's a lot of infrastructure there, so they don't need to spend 500 million or whatever on infrastructure, etc., etc., etc. Which takes time, due diligence. You have to do the work. So I expect people to do more work than me to beat my returns. I expect people that do more work than me and have more patience, etc., to beat me. Maybe they have draw better conclusions. Maybe they are better connected, etc., etc. But that's true in anything in life. And like always, everybody knows how to get in shape. That's been known since dawn of civilization. And everybody wants to be in shape. So why is not everyone in shape? Because it takes a lot of work. It takes discipline. Why should investing be any different? Why do people start the year with a New Year's resolution to get in shape, and why do most people stop working out 3 weeks later? Because they haven't seen, the results are not quick enough. So people who's like, oh yeah, okay, I'm starting to buy in juniors here. Oh, I get it. It's cheap. I get it. Okay, nice. It's like, oh, people say you're gonna make money from these levels, like including me, and then boom, all of a sudden it goes even lower. It's almost like you're getting fatter. If this was when you started training out and you got fatter. I mean, at surface, obviously looks like, obviously I was wrong. It looks like this is not how to play. Yes, it is. It's just that it gets cheaper first. And the worst thing to do is to change course. Again, it's like if you worked out for 3 weeks and you expect to be sitting with a 6-pack, No, it might take years, but it's going to be worth it if you just keep it up. So we have to stick to our strategy. Buy cheap, buy cheap. If it gets cheaper, buy more, buy more, buy more, buy more, buy more. One day it's not cheap, and then, you know, everything pays off. But that might be months or years. Thanks for listening. Again, don't take it the wrong way, David, and these are my 2 cents. And I think this is again very, very human. I mean I think I understand where you're coming from, and I've seen, you know, I've seen comments like this on Twitter all the time, basically. But I want this to be again, it's like dig in more. Okay, when you figure out why Pierre Lassonde said what he said, then you'll get it. Then you know you'll get it. Then you won't get triggered by somebody saying what Pierre Lassonde says. Then you finally understand what he's seeing. And then you're not going to get pissed when you hear that or somebody else says kind of the same thing. That it's pretty straightforward, actually. But in the meantime, there's a lot of stuff we can do. Because he doesn't expand on it, obviously, but what he's not saying is to just buy only the near bankrupt companies that are the smallest, have the no integrity management teams, and then it's like expect everything to work out fine. No, we have to take some personal responsibility with our due diligence. But the overlying theme or underlying theme is the fact that this sector goes like that. Thanks for listening. Bye.